And we're live. All right. So welcome back to the Capital Mindset Show, guys, the live show. And yeah, so we got a lot to talk about. I'm trying to get these a little bit more organized when I do these ones. And well, I'm a little bit mentally tired. So this is kind of like my break of sorts. I get to have fun with you guys now because they actually are fun. Okay, these live streams. All right. So after basically about, I don't know how long I've been, doing all these like freaking compliance things, but yeah, since about like 9 o'clock this morning. A lot of random stuff. Some of you guys know kind of what I'm doing right now, but anyways, so I'm going to be going in order of the topics. You can see them down in the description below. If you guys are curious, you'll see it in order. And towards the end, of course, we do the typical Q&A. But the first thing I guess we're going to be talking about is the DUI video. Okay, so something's going on with the Me Kevin DUI video. We have to address it. That's the fun topic. And then we'll get to the more interesting stuff. Well, in my opinion, interesting. But YouTube finds this part interesting, which is the DUI video. Yeah, if you haven't seen it already, it's pretty fascinating stuff. I would say that when I took a look at it, I think it's quite obvious now that Kevin was, definitely had a wee too much to drink, to say the least. And that there probably goes away any political ambitions the guy has, because that video is, I don't know, it's pretty, I don't know. We'll see what really happens. I'll be standing on the side, just kind of watching. I'll be busy, but I'll be watching on the side, entertained as much as you guys, as far as what goes on, whether or not he pursues legal action against that individual. I don't think that there's any chance of victory, but there's probably like a chance of, but then again, I don't know where that individual lives, because there are some states that have some protections against that. And again, I'm no legal expert by any stretch of the imagination. I'll just, sit back and watch it, interestingly. I don't know if you guys have seen it, but I'll say this. Definitely don't go see that video. Definitely don't see the video. Don't comment on the video. Don't share the video. Don't do any of those things. Because that would clearly expand the reach, and that's not condonable. Okay. and actually, just to say that, I think some context with that is, well, we'll get to that in a second. All right, so that's basically it I want to cover with Me Kevin's DUI video. If you guys see it, you probably got a big laugh out of it. The next topic I'm going to be covering is Everything Money. Okay, so Everything Money had recently made a video that I think was overly complicated. And I was discussing with some of you guys last night. It was regarding the Moats video. So I'm actually going to find this video and pull it up for you guys here. So you guys can get an idea of what it is I'm talking about. So I'm not going to really play the video, or no real desire to play this video here, but I recommend, if you guys are interested in just seeing what I'm talking about, you can give it a look. Wait, what the heck? Was it the... Okay, there it goes. I thought for a second it was deleted.
Got it.
All right, so let me pull it here. Let's go. Let's remove this here. We don't need that. All right. So if I show you guys, and I have... wait, hold on, wrong one. Which one did I do? That, by the way, was an on-purpose slip of Jeff Snyder, because we're going to be talking about him. All right, so let me pull this here. It's kind of like how Jeremy goes, oops, didn't mean to show you that. Yeah, that's a foreshadow. So we're going to see this video here. We're not going to watch it, but it's titled, if you guys can see that there, it's titled Why Warren Buffett Believes in Moats. Okay, so they go off of this whole conversation that, is kind of interesting, I guess, between the three of them. I thought it was interesting how the disagreements happened, but I think that the actual... part was overly complicated in terms of like what it is that they were saying. So let me explain. So there's a concept of moats that they were kind of diverging from. So the moats, and if we can go off of, for example, you can probably use sources, I don't know, like Morningstar or anything like that. They have nice definitions of what you can define as a moat, but think of a moat as you have the switching costs, right? They talk about that a little bit, and you have intangible assets, which I think is primarily what they were talking about. Then you have network effect, which is something that they didn't really talk about too much and actually contradict themselves a little bit. But then they have cost advantage, and also you have efficiencies of scale. So you can actually go into each category, break it down a little bit deeper. But, for example, switching costs is pretty simple, pretty straightforward. How much does it cost me to switch from this product to another product? Intangible assets, that it can be branding. You could think of it like that. So, who can be a Coca-Cola? Coca-Cola can be Coca-Cola, Pepsi can be Pepsi, et cetera, et cetera, et cetera. And you also have, like brands such as shows like Marvel. So Disney owns Marvel, Disney owns, Mickey Mouse for all intents and purposes. Those have value. People can't produce necessarily another exactly the same thing. You have one and done. And so that builds power there. And then you also have the network effect. You can think of things like, Meta, so like Facebook, Instagram, TikTok, YouTube. These are network effects. Why am I not going on to other similar websites like YouTube? Well, it's because they don't have that network that's necessary to establish a growing and vibrant community. And a lot of those companies require that. So that's the moat there. Cost advantage, also self-explanatory. Think of a company that can produce the same product for a cheaper price, kind of like getting you that same thing or service in that case as well. I can get you the service for a cheaper price, and let's say quality is relatively the same. That's another form. And then you have efficiencies of scale, which is kind of relates to the other one. But let's say some businesses, in fact, they require a big size in order to actually compete efficiently. So let's think of, for example, a massive manufacturing company. The moat for that company is, let's say, the factories. You have to build out the factories. They already have the factories established. Now, I also want to kind of consider this is another form of moat that's kind of getting a little bit more into the meat and potatoes or the meta of things is, let's say, I have a lot of cost inflation. And so if you've already built the factories and let's say there is some sort of, economic event that's causing a good amount of inflation. Well, that in of itself kind of helps out the established players, because in order for me to now build the factory now, the cost of construction materials, let's say they've risen. So the investment that the company has made in the past, and now perhaps it's not going to take that investment to build that new factory. It's going to take a bit more. And then depending, all else being equal, maybe I'm adjusted to that newer base point of the monetary value, but maybe I'm not. And so that actually helps out incumbent players there. So I think that their video kind of, it made it overly complicated. I think it could have just been put simpler. These are the types of moats that exist, and then given an example of one. I'm thinking about doing a video like that instead of just complaining about it. Just make a video simplifying a little bit better and giving examples of each kind of moat. But I've kind of already done that here. I might do it again and in like a video format, not a live. So one other thing that I wanted to talk about regarding Everything Money is kind of twofold. It's I've talked about this already before, but for those of you who are newer to the channel who will be seeing this, a bit of the irkiness of the claim that you can't show your holdings because of legal reasons. I think they should really, if you're watching, any of you like Seth, or you're watching this, change that. Change that. That looks bad. And I think that's like a weak point to your arguments against, some of the people you've been going out against, which is good on you, because again, you guys have a big community, big platform, and so you're going to be more impactful there. And then the last one is kind of like the PayPal valuation is something I want to kind of highlight. I talked about this with some of you on the General Discussions Discord call last night. And we were talking about this, how if you take a look at their PayPal videos, you can kind of see the evolution over time. The 7 month ago video, you had a high price point of about $200. Of course, you can expect some degree of change, but to what extent is it do you say like, okay, well, we were so wrong that the price points are, more than half what they were before. So kind of food for thought there. And then that's where I'll kind of end that conversation on Everything Money. All right, so as far as some of the macro, and did I receive I think I received a super chat. Okay, I received 2 super chats. All right, thank you, Cole. So we got empty 99-cent super chat, and then we got $4.99. Rank my 3 memes live on stream. Okay, so Cole, what I need you to do then, in order for me to comply, send me the memes. Are they on your YouTube channel? And that will help me find them. If they're on your YouTube channel, I can quickly go on your YouTube channel and find it there. All right, so with that being said, until Cole responds, I'm going to then just segue over to the next topic. Again, if you're just joining, topics can be found in the description below. And then at the end, I'm going to be opening up to Q&A. So third topic that I want to talk about is actually the yield curve inversion that some of you have been talking about as well. We talked about it on the last live stream or a couple live streams ago. And this one is actually an interesting topic because something that Jeff Snyder has actually been pointing out lately is the Federal Reserve is kind of pivoting what the yield curve inversion means or what is important about the yield curve inversion. I'll explain. Okay, so we'll get to yours after I finish this point, Cole. Thank you for letting me know. All right, so with regards to the yield curve inversion, we have the Federal Reserve coming out and saying, well, you should, and I'll actually quote them here. Kind of quote them. It could vary a little bit in the language because I'm going to then simplify it and translate it into English. So the nominal yield forward spread with a 6-quartered forward ahead and the current 3-month Treasury bill rate dominates the spreads as a better indicator. And this comes from an article given out by the Federal Reserve. In English, what that means is that their claim is that the short end of the yield curve is actually more important than the long end of the yield curve, the long end being the 2 to 10. So that claim, whether or not it's true or false, could be debated, I'd say, very much so. And you probably could tell which side I'd probably fall under as to my personal opinions on it. And some of you out there, actually some of you who may be working in your various respective fields that do some research akin to this, will probably have your own opinions as well. And if you want to, you can drop it down in the live chat and we can talk about it. But yeah, that's kind of what is a bit of an interesting part because we have now a sustained yield curve inversion. We had a small one earlier this year, and then we had kind of blips in the bond market last year, at least twice last year, one in February, one in October. And so with that, I'm going to segue over to fulfill Investing with Cole's request. So we're going to go to his YouTube channel, and we're going to rate his memes. All right, so I'm going to pull up your YouTube channel, and we have, okay, so it's your latest videos I see. Okay, I see. It's less than a minute long in total content, so it doesn't actually take up too much time, so it's perfect. So this is the first one, and you guys should be able to hear the audio as well.
Hello. Hello, officer. I'm from California. I'm clueless.
Tasteful. Okay, so I like that one. That one was pretty funny. All right, so
Get on to Cleveland. You just blew right through the stop.
Where's that $10,000 one? Yeah, that's right. Yeah, I like the first one better.
Hello. Hello, officer. Do you know why I stopped you? How much did you have to drink tonight? Nothing. You haven't drank anything at all? Okay.
He lets him go.
You could get some special perks with FTX.
All right, I'd probably go with, I don't know. In terms of ranking, Cole, I'd probably say between the first and the last one. Middle one's a bit too, there's a lack of context for me, but I think I'd probably say the first one's the best one. First one's the best one. Third one is the second best one, and the worst one is the middle one. So all in all, though, I mean, there's going to be tons of memes actually coming out about this. I already been seeing some of them. They're pretty funny, but this is just the beginning, you could say the least, definitely. So there, that is the ranking there. All right, so back to some of the concepts that we're going to be covering here is now I want to cover REITs. So REITs as a whole have been performing terribly in some cases and okay in others. If we actually pull up, for example, like if we say VNQ, right? So I pull up VNQ. So this is the Vanguard Etf for REITs or real estate, and I'll actually pull that here. This was actually requested by some of you to actually take a look at. Let's just take a look at the, let me remove the chat here. Boom. There we go. Okay, so let me actually move this to the side like that. That's better. I think that's better right there. Yeah, right there, because we want to see the name too. All right, so if I pull up the 5-year performance, you can kind of see how it is relatively the same to where it was prior to COVID. So $91, you hit a high of $99. And during the lows of COVID, I mean, it's still up about 52%, so not too shabby there. Now, if you actually take a look at the 1 year, when did this actually start to drop? Well, we see coincidence, I think not. For those of you who are new to the channel, you guys know, old to the channel, you guys know exactly the context going on here. And so from about this standpoint, we are 21.44% lower. So year to date, we are down 21%. All right. Fairly straightforward there. Now, the next stock I'm going to be kind of talking about is kind of transitioning over to VICI. And again, I'm going over these because I'm trying to kind of talk about them because they've been requested. And VICI is a company that I've talked about in the past in a favorable light, to say the least, because what I like about VICI is it's a double-edged sword, don't get me wrong, and I've talked about this in the past. If you watched the MPW video as well, I don't think I have a dedicated video to VICI. I've only talked about it in live streams. But what I've said about VICI in the past still stands today, that the property types are fairly unique in the fact that, well, what you're getting here is a company that has, like, let's say the Venetian. I think they actually finished the purchase of the Venetian. So the Venetian, what else can move into that? Not much, but what can the Venetian do? Can they build a new Venetian right next door? No, they can't. It's not so simple. So it's a double-edged sword there where it's to their benefit, but if, let's say, that tenant goes BK, then what else are you going to put in there? I mean, I guess you could transform the property, but, it won't be an easy process. It's not an easy transition. So the resistance to change is going to be greater than, let's say, a multi-tenant property where you switch out one tenant for another tenant, which is just a person who wants to live in the apartment, right? That's pretty seamless. With something like the Venetian, it's a bit more, let's say, unflexible or lack of flexibility. All right, so then the other company I'm going to be talking about is STOR. So STOR is another one. And let me also highlight, because for a lot of REITs, we care about, for example, the yield that we're getting on them. So the yield here is about 4.47%. You wouldn't use the PE ratio here, by the way. Just a quick friendly reminder that with REITs, you definitely don't want to be looking at the PE ratio simply because of the nature of how they operate their business. They are REITs. So their business is using a real estate, right? That's how they earn all of their income. So we have a lot of accounting line items that we actually redact from the operations, and so we want to add those back in. We create, or we calculate that and get FFO or AFFO. Okay. By the way, I apologize if I do any stuttering, because I'm about going off of, I guess now close to 12 hours of activity. So with regards to VICI properties, that's what I like about them. Now with STOR, we're getting a different flavor entirely. We're getting a triple net lease. So for those of you who don't know what a triple net lease is, we have several, like a net lease, double net lease, triple net lease. This is basically a spectrum of sorts of how much liabilities or how much of the maintenance goes to the tenant versus the landlord. So STOR Capital here is getting absolutely punished, and perhaps deservedly so in some instances. So if you look year to date, they are down 22.98%, which again, let's compare it to the VNQ, so the broader index. And so when we take a look at them compared side by side, we see that STOR has underperformed VNQ. Now, if we pull out the 5-year, I'm actually curious. So we're removing dividends, by the way. This is simply capital appreciation, so keep that in mind. VNQ has actually underperformed STOR Capital. So STOR Capital is outperformed. All right, so let's remove this now from the equation, and I want to actually take a look at it. So over the past 1 year, we can see STOR Capital has actually been kind of on this downtrend ever since July. Well, even before then, I think it peaked out. Yeah. It peaked out around July, August. So that's actually where it kind of, and so since then it's kind of been downtrending. But what's unique about STOR Capital is the strategy. So the founder of STOR Capital, what he basically implemented here is something that they'll go for lower quality tenants. So not as high quality, so in the commercial real estate world, you have what's it called, investment grade tenants and non-investment grade tenants. STOR Capital will actually try to focus on those. Well, they'll always say this, obviously, but higher quality non-investment grade tenants. And what are the benefits of doing that in pursuing that strategy is you probably get better agreements as a landlord. And you could, for example, perhaps price in certain rent increases that you couldn't with an investment grade tenant. So think of it like this way. You own a piece of property, and then you're going to be dealing with a mom and pop shop for all intents and purposes, or a regional firm, versus something like Home Depot. All right, so Home Depot can easily acquire capital versus, let's say, a local store, and so Home Depot can negotiate more with you because they don't need you as much as you probably want them. You want them for the stability, and they just want a good location. So they're going to have better negotiating power against you. STOR Capital would say, okay, well, let's find tenants that we can determine are good still, but are not in that high investment grade quality, so we can get better leverage on that negotiation. So that's their strategy there. And they have, I think it's called, the specific terminology is, I think, is master lease agreements. So they're able to see how their tenants are doing and actually take a look at their P&Ls on almost a regular basis. So that's interesting about them, which is kind of contrary to something like which is realty income. Realty income down about 1.19% today. But again, this one is the one that actually went against what I said back in January. So they didn't care at all. And so I've kind of shared with you some of the reasons as to why that might be. So if you actually take a look at that January, if you go back to that January video, you can see how that one did not age well with this company. And this was a holding in my portfolio. So it was kind of like a waste. And in fact, thank goodness it wasn't a tax advantage account, because if it wasn't, it would have actually been to my detriment in a holistic standpoint, because I would still be paying taxes on it. It's not that, I sold it and it's about the same price. You have to consider the tax that actually gets removed that I would owe the government on that sale. So, and by the way, REITs in general are typically better, depending on your situation, the country you live in, et cetera. So consult your licensed professional that handles your stuff. They're typically better, though, in a tax advantage account. Well, almost like all stocks, but there are some entities that, be very careful, because they do complicate things when you put them in a tax advantage account, but that's not this kind of video. So with realty income, what they kind of differentiate themselves in, aside from other REITs, is that they're pretty much triple net lease all the way. You can kind of go through their portfolio on their website. It's pretty simple to navigate, and you can see their tenant lists. Pretty solid companies all in all. They try to focus more on the investment grade tenants. You can also take a look at something like Agree Realty, which actually has a higher proportion of investment grade tenants. And then we also have other kinds of companies, for example, like STAG Industrial, Duke Realty. So I'll pull up STAG Industrial. This is a favorite among dividend investors, I guess because it's a monthly payer, similar to realty income. So they look at realty income and STAG. That shouldn't be something that makes you invest in a company, by the way, if you didn't know that. I hope you would know that, but you should know that now. The fact that, it pays a monthly dividend is nice, right? And I see a question, where am I based out of? I'm not based in a cold place. I just have the AC on really high. I like to have my house cold, so. RK, REITs are boring. Yeah, well, REITs are boring. Yeah, they're boring. But they make money. They're one of the best performing asset classes in the past 20 years. So they're boring, but they're good. And so STAG is like the small baby. We're about to finish REITs because I'm going to talk about Prologis and then moving on. So Prologis is the, Prologis. Here we go. I forgot their ticker. Prologis, there it is, PLD. I always forget their ticker for some reason. So PLD is actually the big boy of the industrial REIT sector. And you actually take a look at their performance, and they actually followed it nearly perfectly as well. So they had this time when they actually were going up, and it looked wrong, or that January video did not age well. And then they actually fell precipitously, down 31.10%. So they kind of fell more or less in line, I believe, with the earnings reports of Amazon or Walmart, and where they were basically saying that we overbuilt a lot of these warehouses. So something like Prologis is like, well, you're saying that there's too much of what we own. That's not going to be good for negotiation down the road. So the market's kind of a little bit pessimistic on that front. Also, I guess the market was pretty optimistic in general on this company. If you actually take a look before pandemic versus now, the market was really exuberant on this asset class, on the industrial space. I can tell you, if you actually are working in a real estate company right now, you can probably give some feedback here. How are industrial properties looking right now, like warehouse properties? What are the cap rates like? Are they desirable? Absolutely. The answer is yes. They're very desirable right now. Maybe not as much as they were, just a couple months ago, but I'd still say it's pretty hot. I wouldn't know anymore, but yeah. And then the next topic we're going to go into is the streamers. So I've had some questions thrown out to me about Paramount Plus or Paramount. So this is the stocks. We're looking at the Class B shares. So the PE ratio, it looks cheap just on that preliminary look at 4.10, dividend yield of 3.92%. I believe this is the one that Warren Buffett's been buying. I don't really like their content too much. I guess I don't. You guys would probably be good to actually take a look at. But yeah, I see that someone made a comment about Prologis. Right, Prologis, absolutely, yes. If they keep coming down, of course, at one point they're going to be an interesting buy. By the way, anyone joining now, you can check down below in the description. That's basically the order of the topics. And again, towards the end, we're going to get to the Q&A. So, what do we see here? How can they make me rich when they already made people rich in the past 20 years? So that's a very good point, because that probably goes more in lines with the larger REITs, but it still does depend, because that can still surprise you. You would think that there's just only so much real estate to go around, and eventually it's going to be all gone. But there's so much. It's really fragmented. But I get the sentiment, because if something's performed really well over the past 20 years, who's to say that's going to continue in the future? And you shouldn't do it based off of that. It's simply that REITs were a boring business back then. They're a boring business today. Oftentimes, boring business are the ones that are overlooked. That's basically where I'm going with that comment. Not so much that because they've outperformed in the past, that means they're going to outperform in the future. That's not at all. I would never make an argument like that. So going off of streamers like Paramount Plus, though, it's cheap, but I think it's cheap for a reason. So let's actually start pulling up their financials. I'm actually going to take a look to see if there's anything crazy in here. So let's go Paramount, and let's probably look at the 10Q, or maybe they have a 10K. That's the most recent filing, but I'm probably going to bet on a 10Q, because I'm going to go to try to find their balance sheets. That's an inside joke, by the way. If you guys don't know where the term balance sheets comes from, you can ask anyone in the chat. Okay, so let's go to the SEC filings. Click there. Okay, so we're going to find, and I'm going to actually pull it up in here, don't worry. All filings, we're going to go to, let's go to current reports. I'm sorry, not current reports, quarterly reports. Okay, so that's May 3rd, and just to check, yeah, that would be it. HTML, let's go PDF. I like the PDF versions. Okay, so let's go to the financials of this company and just kind of see what the heck's going on in there. So let's go to statement of operations, comprehensive income, balance sheets. All right, beautiful. So let's pull this in here. Control zoom in. Let me make sure it looks good for you guys. You're not too zoomed in. All right, so we're looking at just a quick glance at the cash equivalents. Okay, 6.2, 5.3. Then we're going to take a look at the operating cash flows, see how much they're actually spending on that content. So we do see Goodwill. They've been making some acquisitions in the past. Goodwill's still sitting at about 16.5 billion. They could be, I don't know what they acquired, but they acquired something not too long ago, I think. And then as far as the liability section go, the long-term debt's sitting at about 16 billion. It's down actually from 17.6 billion. So, let's kind of make a quick judgment off of the operations of the business. Is that sustainable on an eyes glance? Let's go to the let's see here. So net cash flow provided by operating activities. Of course, as a streamer, we should expect this to be pretty low as they start to spend more and more on content. Now, let's see that. Where's that negative spend? Okay, net earnings from continuing operations, operating activities, investing activities. Don't really show it here. It's pretty lackluster, if I'm being honest. Loss from extinguishment of debt, deferred tax, stock-based compensation, amortization. Okay, so let's go to the income statement, kind of explore this. Sales, cost of sales. Okay, that's that. That's fine. I mean, if we're going off of just like, for example, the net income, it's still down on a year-over-year basis from 2021 to 2022. So we're sitting at $433 million. And let me remember, what's the market cap? I mean, this is $16.4 billion company. So even if we go off of, and by the way, this is quarterly, so it's not annual. So if we annualize that, I mean, I'm going to probably go into the 10K now to kind of get, I really want to see how much we're spending on content. 10K, where's my 10K? Because I just wanted to see the most up-to-date balance sheet, and then I'm going to go on here. Financial statements. Okay, let's see here. I mean, all in all, in terms of net income for the year, they made about 4.5 billion. So that's pretty good for the size of the company, for the market cap of the company. But I'm trying to see how much they spend on content. Net operating activities. All right, right here. Increase inventory. No, that's not the number I'm looking for. Okay, so that's program amortization. So program amortization was 13 billion. I wouldn't really. I mean, from there, we can do the dirty method. We can do the dirty method of calculating kind of how much they spend on content, which should be a decent amount. And also, they probably have projections. So Paramount Plus, if I pull that up, yeah. So it actually is in line. So about 14.7 billion. It's pretty much in line with the dirty method of finding that. So 14.7 billion is the projected for, or was that 2021? I think that was 2021's numbers. Yeah. So 2021's number was 14.7 billion. So kind of far off some of the other ones. For example, like Disney's at 33 billion. Netflix is at 17 billion. And who else is reported? I think Warner Bros. Discovery is somewhere along those lines as well. So I think like 20 billion. But with a lot of these streamers, you're definitely going to get a massive amount of content spend right now. And they're very difficult businesses to really evaluate in reality. So for the most people, they're going to look at this and say, well, the cash flows are terrible, and they're almost consistently terrible. But that's because, again, we're kind of including in that category. We're in that spend at some point because cash is actually leaving the business. So the statement of cash flows, of course, should reflect that, that's going into some content spend, which is like basically growth CapEx in some capacity. But yeah, Paramount Plus is not really for me. And as far as, by the way, if you're wanting Warner Bros. Discovery, I'm not getting into that one yet because I'm going to do a video on that one when the numbers are kind of together. And then Netflix was weird today. If we actually go back to, let's actually, I don't want to show that one yet. Where is it? Where did I put it? Here we go. So with Netflix stock, I want to show you the price action because it was really weird today. Okay, just go ahead and don't participate. There we go. All right, so Netflix today was up and then just basically collapsed throughout. Well, collapse is a strong word, but it fell throughout the day. So, which is nice because I was actually kind of complaining about this. This was kind of annoying, but a lot of people are kind of bracing themselves for the loss in subscribers that everyone's talking about right now. As the company's kind of trying to transition over into figuring out advertising and all that. I don't know how I feel necessarily about advertising. I don't know how you guys feel about advertising, but yeah. Okay, so I did get a question, and I think this is a good question. So Capital Mindset, why do you / Jeff Snyder say that QE is not money printing and it's just an asset swap? The banks can't loan out treasuries, but they can loan out cash, meaning the money is created. No, it's because actually they're not given cash. That's not what they're given. They're just given reserves. So it's because the QE itself is not giving the bank any cash whatsoever. It's just giving them a reserve. And then the reserve is not spendable money. So the bank is actually what creates money. So then the bank can just loan out more money, but they cannot give you reserves. So no money was created in that instance, but the bank can. So if lending growth happens, then you are creating money. So it's that key detail. There's going to be a video all going over QE and why QE is not money printing and why it's just an asset swap. There is one case in which the money is actually done, and I've talked about this in the past. It's in a process called portfolio rebalancing, but it doesn't happen at the banks. It happens at funds. So when portfolio rebalancing occurs, because through the banks, the Federal Reserve can operate a QE transaction, then they actually get cash. They get cash, but they get it from the bank, right, in this instance. And the bank gets the treasury. The treasury is then given to the Federal Reserve. The asset swap happens, and then the bank gives them the cash, right, for it. So it's facilitated through the banking system. But most of that money finds itself in the financial assets anyway. So in theory, if that is correct, guess what you should see with QE? You should see a greater increase in asset prices. Oh, well, what did we see? We saw a greater increase in asset prices. But yep, that's the video's coming. Don't worry. It will go into that with visualizations and everything, making it a little bit easier to follow than just me verbally saying it here and just going blabbering around. Okay, so, and then the next topic that we're going to be kind of covering, I don't know why this is repeated. This shouldn't even be repeated because we already talked about everything money. So if that's repeated, I'll remove that in the description. We have also option strategies going forward. I don't really like to talk about options because I think almost it's irresponsible too much to talk in depth, or not in depth, but to kind of discuss option trades, because for the most part, most people shouldn't even be involved in them. But I've shown, I think I have at least 2 videos in the past showing like my options investments or my options trades, and usually, and I think both of them are not any purchases of calls; they're sales of calls, and I don't even show the sales of puts. But option strategy going forward is pretty much again going to be fairly the same. It's going to be, if the market allows for it, where I find an opportunity where I can sell some calls, maybe sell some puts. That's probably what I'm going to do. I'm not really having any plans of doing any options. So I just wanted to cover that and just say that out there. We got a follow-up question. See, that's what these are for, by the way. These live streams are for exactly this. When COVID happened, you would expect lending growth to stop if you believe QE doesn't have any impact. But we saw lending growth explode right when QE was implemented. Well, yeah, but that's in isolation of the QE. So QE and lending growth don't necessarily go hand in hand. What we did see a lot of, because, for example, so it's the bank's relationship with you and the lending growth that occurs. That's the lending growth where it goes. You don't go to the Federal Reserve and say, I'm going to borrow money from you. That you can't borrow money from the Federal Reserve. The QE is simply just a relationship between the bank and the bank of banks, which is the Federal Reserve. And so when they give them the Federal Reserve asset, which, by the way, one kind of smell test of this is you could say, okay, how many dollars were supposedly printed? And then what was the level of inflation throughout that time period? That's kind of like the beginning smell test to why you could say, okay, well, we printed that much. We printed that much money. Why didn't we see that level of prices rising, right? And we're kind of using the modern use of the word inflation because if you go back to the older word of use, inflation, expansion of the money supply, that's separate. Then someone would say there is no inflation, but there was prices going up for various reasons that we could probably get into. But yeah, it's the relationship. So then the follow up here, Calvin said, QE doesn't directly mean money creation, but it gives the banks more ability and incentive to create money. That's the idea behind it, but it doesn't always equate to that. So just because we get, incentive to do something doesn't mean that they'll do it, which is actually the crux of it. Because at the end of the day, then we have to then kind of come to terms with the act of QE. And that's why I always say in isolation, QE is not the source of the inflation in isolation, because it's just a process. It's just a swap. It's ideally supposed to encourage a certain behavior, and someone like Werner goes into this actually a little bit better than probably what I'll get into it. But for example, the purpose of QE was when it was first thought of, to remove the toxic assets so that the banks can feel more comfortable with lending out while getting those toxic assets put away from the private balance sheet and into the public balance sheet. And so under that understanding, okay, we can say, well, in theory, they should want to lend out more. And so, but one of the problems is that, and some other people can point this out too, is that the QE has been used to purchase pristine collateral. And I use the word purchase incorrectly, to swap out for pristine collateral, otherwise known as treasuries. And treasuries are used to settle transactions a lot of times. Reserves can be used for that too, but pristine collateral like treasuries is used a lot in the foreign markets, right? There's still a use case. That's why they're even willing to take on, crazy yields at times, where the market is behaving in ways that we think, okay, that shouldn't really be happening. That shouldn't happen, but yet it is more of an indicator that there's something else behind the story. There's something else really going on. There's something else that treasuries are used for, not just, I'm holding it for the maturity. But yeah, in essence, it creates the incentives for it, but that doesn't necessarily mean incentives equals results. Incentives don't always equals results, because that would imply that that's the only incentive necessary to get that required behavior result, when it's not. We require a bunch of more things. Okay, so then we got, I love this. This is going back and forth. So there's a correlation between QE and MS and not a one-to-one. Variable gamma that relates to the two. Game is positive, but typically less than 1. Snyder would think gamma is equal to 0. No. It's not that it's not going to happen, right? Money creation can still happen. So they're irrespective of each other. So QE being the asset swap doesn't mean that banks will or will not lend out more money. And in fact, it's more of a warning sign. And that's something Jeff Snyder points out, not that it's 0. It's a warning sign that if banks are not lending out money in such an environment, that's a bit problematic, or that's a sign that there's a problem there that people aren't really addressing. And that's what kind of like the issue is around there. So I'll wait for the fallback on there. But yeah, correlation, Bacon memes is correct there. That's a classic rule that we can accidentally break sometimes, but correlation doesn't equal causation. So we got to be careful when we equate something to being the cause of something. Of course, actually, I think the federal government would probably desire the American people to probably think of the Federal Reserve as the one causing some things, but not necessarily the case. QE is boring more than REIT talk. Yeah, probably. For the most part, it probably is. All right, so, and there's one more thing I do actually want to talk about before we enter the Q&A section, or the strict Q&A section, and that is the new products, or the relatively new products, which is the, what's it called? ETPs. I don't know if you guys have heard of these, right? So ETPs, they're going to be becoming a bigger part of the market, so to speak. And you can get ETPs, which are basically shorting instruments for individual stocks, various leverages. I'm not saying whether or not they're good or bad, but it's just interesting how the market is kind of going in that direction. And you're going to be able to eventually short anything. So you can short Tesla at a 3x leverage, or 1x leverage, or you can short I don't know. You can probably look up what kind of products exist right now at this present moment in time. It's by no stretch of imagination an endorsement on any of them. But it's just interesting that we're moving in that direction where it's almost like you can hyper customize portfolios in even more ways than one. Like there's more than one way to short a stock now. You could just buy the ETP. But, in consideration of that, consider what an ETP is. If, like, you wouldn't hold a inverse ETF for a long period of time, right? For like an extended duration. So, for example, you don't have a short NASDAQ. And you don't say, I'm going to hold that for the long term, right? The risks, are insane. But it's more for a specific timed trade that an individual would engage in that. Similar with these ETPs. But I think that's interesting that these new financial products, they're going to become more and more commonplace. And then the last thing I'm going to be talking about is the Google stock split. We saw that today. I don't know if you guys are seeing that, or if you guys live under a rock, but we saw the Google stock split. We got 20 shares. I can finally sell call options. Well, I could before, but it was too little in terms of how many contracts. But now we can finally sell a decent amount of contracts. So it gives me a bit more flexibility and kind of choosing the size of the position that I want to actually generate premium from. But yeah, I don't know if I'm going to do that, but maybe I do. I'm not really too excited about that, but I think it's cool that I can now. And so same with Amazon, but Amazon less so. But Google being a larger position, I can actually kind of extract some stuff out now if the market allows me to. All right, so now we're entering the Q&A. So basically now I'm just going to answer you guys' questions. Okay, so Carson, a follow-up question. Oh, let me actually move your thing up so you can. Okay, so I'm pretty fascinated by the topic, and I've watched a number of Snyder's videos, but I couldn't find any videos breaking down QE. I will have a video breaking down QE, and I'll make it images. I'll do a there is actually, I think, one out there, but there's one that doesn't go into, for example, portfolio rebalancing and how that affects markets, for example. And that's probably something everyone's interested in. So how QE does affect markets. So there was, I don't know if it's it probably sounds conceited, but there was an article I wrote back in 2020, in actual March of 2020 on LinkedIn, which was actually kind of talking about this, but I put it in layman's terms because it was LinkedIn. So it actually was going into that. As the Federal Reserve was changing policy, why would you want to actually buy stocks? And stocks were crashing in March of 2020, by the way. Fun fact. And I don't know if you guys knew that. But that was a bit why, right? So, but it was more put in layman's terms. I think let me actually pull up the title of the article if anyone's curious. But it's a really basic article. It's, again, written for LinkedIn. And LinkedIn, if you write anything on LinkedIn, it's just for fun. All right, let me, I have to go to my profile, view profile. Where do I go? I forget where I have to go. It's like activity, somewhere around here. While I'm simultaneously trying to multitask, I'll try to read a question and at the same time try to find out where my articles go to the nether. Okay, so we have a couple questions coming in. Okay, so because I know most people don't understand QE, but I have a hard time believing Snyder when he says the Fed literally has no real effect on markets, only psychological effects. So yeah, I think that what he's going a bit on the extreme end on that part, but because like there is a portfolio rebalancing effect, but the thing is the problem with the portfolio rebalancing effect is it's almost entirely on the stock market and not on the broader economy. Which is problematic because that's like the opposite of what you want. Which is kind of why how Japan has attempted QE forever and has the same results as forever, and the decision is to continue to do what you were doing before. Just do more of it, and eventually it's going to work. And that's kind of like the Japan strategy, which makes no sense, right? Gosh darn it, where the heck is it? So let's go on more. I think it's more. No. It's crazy. There has to be like an activity section. I don't really know how to navigate this website. Home. Oh wait, I'm making progress here. Someone can probably find it. Anyways. Or wait, if I go to write an article. Anyway, I want to answer questions more than that, but someone could probably find it. All right, anyways, capital mindset. Fabio, how are your targets on options premium income if you are selling calls or puts? Okay, good question, Fabio. What? So I don't know exactly what you mean by that question. Maybe I'll answer it in a different way, and I don't know if that's exactly what you meant, but here I go. So what I do is I like to sell calls and puts. And it needs to be, if it's a call, for example, I need to be happy with the strike price that I'm going to exit at, right? It's basically like, for example, I refer you to my older videos. I have 2 videos on the channel about this. I have one on Unum where I showcase the call options that I sold. And I also have one on AGRD where I showcase the call options that I sold. Like I said before, again, if someone really was trying, you can't actually tell the portfolio size by those videos because it's not, I didn't do like it on the entire position, but someone could get an idea. Like I said, eventually things slip, but someone could potentially tell. Anyways, aside from that, if you go to those videos, you can gauge whether or not my thoughts around it, but I'll kind of repeat them here. And it's basically, again, if it's a call, I have to be happy with the strike price that I'm exiting at, and I'm already profitable on the position. Otherwise, I don't really like to do it. And if it's a put, it has to be a position that I'm very adamant about adding. I understand, for example, the nuances of the risks, right? For example, you want to be very careful with the put option strategy. Obviously, if you're thinking something like options is simple, think again, because if you think, I want that asset anyways, and if I do the put strategy, it's risk-free or whatever, I'm just getting this premium. Well, you got to be very careful because, for example, opportunity cost is a real thing. You also have to consider the fact that, what if like you missed out on something? What if there's something wrong? You or stand to potentially lose a tremendous amount of money, let's say. If you're playing with fire and you pick a company that, let's say, goes bankrupt on the worst case, well, you have to stand for that, or you're gonna have to buy back the puts at a much higher premium. So it's a bit problematic. So I'd say it's more nuanced, and it's very, very much on depending on the stock that we're talking about. Okay, so we have more comments coming in. Hola. Yeah, for Keth and Raman's comment. I'm sitting on 50% cash. How about you guys? I mean, I I'm pretty much like, so I've been deploying more money into the market, but basically as capital has been coming in. So we talked about this in like last live streams. Every time it's asked, like right now, I'd say it's actually, I don't know the exact percentage, but it's sitting between 60 and 65% invested. But that's going to come down in like a couple of days, actually. Yeah, today's the 18th. So, but as more cash kind of comes in, I still just kind of deploy it. The thing is with some of the cash that I am holding, you also have to consider real estate because I've discussed in the past. So that's like a little bit of the nuance. It seems like I have a high cash position, but it's actually more so to buy other types of investments, not just, stocks, right? So it's kind of more holistic in that regard. But yeah, as far as like my stock cash portfolio, I'd say I'm right now. But the thing is, like at the same time, guys, if the stock market like presents a tremendous amount of opportunities more than what I see in real estate, I'll just be like, all right, well, I'll just hold off on real estate. I'll just buy more stocks. And then so in that regards, it's pretty flexible. So it's a good position to be in, I guess. All right. So Carson Weekly, you're saying I would say the Fed has more of a portfolio effect. Otherwise, we would have seen a halt in lending in 2020. But we saw huge increases in lending. Yeah, it's not though that again, it's irrespective of that. And Werner actually talks about that too. It's quite literally like you're going off of the reserve theory. So there's a reserve theory where basically it's like that, and I think that's the prevailing theory, which is like how banks, which is a newer way of thinking about it, but banks lend out based on reserves. Or there's another one that basically banks can lend out quite literally as much as they so feel like, as long as they can handle it with certain limitations here and there. And this is globally. What I'm talking about is globally. So it makes it a bit problematic where the Federal Reserve has to contend with something like the Eurodollar banking system, where you have offshore entities that can also create dollars. It makes it a bit more problematic when you're trying to, rein in the anarchy, so to speak. But it's worked for the time being. It has been a flexible monetary system for a long time. It's just having a bit of a problem right now, you could say the least. But all right, so I want to take your entire live stream and wait for your breakdown and maybe respond with a few questions. Absolutely. No, but that's what the live streams are for. These live streams are entirely for questions to be asked, etc. They're for all of that. All right, so what's your opinion on Hedgeye? I've never heard of Hedgeye. You mean, let me see. I think I've heard of Hedgeye. Let me find Hedgeye. Let me see this stock. What is this? It's a website for like stock market news and stuff. Yeah, I've never seen this. Yeah, so I don't really have an opinion on them or not, like good or bad. I don't know, unfortunately. I apologize. Okay, so Capital Mindset, how to value a gold miner. That's gold miners. You got to be very careful. Not so much on the valuation, on the management teams. That's the biggest problem with them. So whatever I tell you is almost like useless because you're gonna have to do a lot of qualitative analysis on the management team. So it makes it a bit hard. But yeah, you're looking at for gold exposure, I assume. All right, QE pushes institutions into riskier assets, a la corporate bonds, stocks. I think also mortgage-backed securities because reserves yield almost nothing and are not allowed to be used in the real economy. Yep, MP, exactly correct. And that's exactly what you've been seeing, a la portfolio rebalancing, which is a bit problematic to say the least. Some actually argue it's a bit more of a problem than other people would like to admit. So you're so you guys are a lot more conservative. So you're quite literally almost on the other end of the spectrum to me, Zastar. So we're like opposite in that regard. But again, with the nuances there. So why not just invest? Oh, I hate those. No. Paul Harsh, no. Not for me. I mean, I don't know about you. I mean, everyone here can do whatever you want with your money. You can do whatever you want with your money, but because I can't tell you what to do with your own money. But yeah, I don't like those. The strategy, I mean, while attractive to some people because of the high yield or whatever, for me, it's just really not for me. It's just really not for me. So the issue with covered call ETFs is, okay, so I don't want to give you the fish. I'll kind of ask you as a question. So what do you think would happen depending on the environment? Let's say, think about what would happen in a market when a market goes up or when a market goes down, and then would you stand to benefit or lose in that instance? for a covered call ETF. Think about like the mechanics of that. And so it's just not for me. I'd rather have more direct control over it because like there'll be covered call ETFs on like the SPY or other S&P 500 variants. But yeah. Which do you think is the best position for the 21st? Oh, which country do you think is best positioned for the 21st century? So again, you guys should not be surprised by this commentary because you guys can just go onto the content library and check out all the videos I have on the VIEs and stuff. So it's not the country that everyone thinks, but I'd say it's like almost like the country you think least or not expecting to do really good. It's almost still like United States is the best house in, you know, even a bad neighborhood. Let's say the neighborhood's bad. United States is still the best house here. So the United States is still really well positioned relative to a lot of the world. You know, you have a tremendous amount of technology innovation here in the United States. As long as innovation remains here, like China was trying to emulate some aspects, but the thing is they're going to lack the totality of the United States. And so, again, I think that they're doing themselves a disservice. And again, this is Capital Minds' opinion for a long, long time. But, you know, again, I'm not talking bad about the VIEs if you guys are new to the channel until they recover. When they recover, I'll talk bad about them again. So I've refrained from making videos on them, additional videos on them. But I think that they're doing themselves a disservice. I think they should open up more. You know, I think that actually would be really good for China. Aside from all the other problems that they have, you know, you can actually, I've shown the charts here and there before how you can even see that something's off over there. But so United States is probably where I'd say there's a lot of optimism for me at least. I know there's a lot of pessimism, but you know, it's like, okay, well, Europe's not doing any better, unfortunately. And it's not that I enjoy that. It's unfortunate that they're not, you know, it's just how it is. Okay. So let's see here. Someone said for gold exposure, oh, wait, I missed some questions. Oh, this one actually is adaptive. So it depends entirely on what we're talking about, what assets we're talking about. But it has to be adaptive. You can't just apply it to everything willy-nilly. So some parts has to be adaptive in the background. Capital Mindset, why did you add GPN and not Fiserv and FIS? Well, FIS is more akin to GPN. Fiserv has a little bit different components, like they have Clover, and they have, you know, like that SaaS business with the banks in the back end. So the reason why I liked GPN is I believe that Fiserv has a bit of a slowdown ahead of them in terms of growth regarding how a lot of banks are trying to, or a lot of the bigger banks, not the smaller banks. The smaller banks are going to keep using them, but a lot of the bigger banks are going to slowly wean off of them. For example, Bank of America is going to wean off of them pretty soon. And something like GPN is focused in their own little, they're basically trying to target that one category, while Fiserv is trying to be like bigger, all-encompassing. And then the other one, I mean, that's probably more comparable to GPN. In reality, it's just the valuation. The valuation was, for me, a little bit better relative to what I expect in terms of growth. So quick answer on that. I don't really consider the FX risk of Google. I assume that the company I think is doing a good enough job at kind of managing that risk. But yeah, it is there because they're a global company. Great time to actually explain, you know, Google is a global company. Okay, so Meta in Reality Labs, I think it's good. I think I mean, we'll see. I can't say anything now because we'll have to see what happens, but I think it might turn out to be good. And you are 20% cash. You see, like everyone's different. Yeah. Dan Weston goes America. Heck yeah. Here in Australia, we're mainly mining and banking, and the mercy of China. Yeah. Your mining businesses are among the biggest in the world. But you have BHP over there. In my opinion, U.S. is still one of the best countries in the 21st century, given its superior demographics like the U.S. I'm also bullish on Australia, New Zealand, Canada, India, and Turkey. Yeah. I would agree with a lot of those that you're mentioning. Australia and New Zealand are interesting. Now, as far as kind of like the geopolitics of that area, well, you have to consider that relatively speaking, in terms of economies, because this was a question brought up a while ago, but relatively speaking, in terms of economies, you have, you know, the Southeast Asian countries that have basically a lot to grow from because they're kind of coming from the bottom in that respect. But Australia, very respectable in terms of development. I mean, I'd say that still United States is all in all the place to be, right? But Australia is not too bad. New Zealand, it's just I think they're also limited by their size, right? How are the demographics in Australia? I haven't really been paying attention to that. All right. But by the way, guys, so this is not meant to be like one of those really long live streams. This is meant to be kind of replacement of the video because I've been pretty busy today. In that note, I'm going to be kind of answering your final questions and then cutting it here. But it was pretty good. Again, I'm still going to be doing videos when I can. It's just today was a very hectic day. Okay, so just waiting on the last minute questions, and I'll close off the stream. It was good. It was good, bro. It was good. All in all, it was interesting. Hamad asks, what do you think? What do you think of having 5 to 10% in gold mining ETF and rebalance? For me, I don't find it necessary. I don't find it. Gold mining ETF. I mean, because you would get extra, you're basically getting a leveraged exposure, and this is where I have to kind of come back and go deeper in some statements I've said in the past regarding, for example, I think it was, what was the company? CleanSpark. So I said CleanSpark is a leveraged play on Bitcoin, right? And that's because when you look at CleanSpark, right, like a gold miner is a leveraged play on gold. It's not that CleanSpark has a lot of leverage. People took it like that, and I'm taking the time here to clarify some statements I made. And it's simply under the context, like comparing it to a gold miner. Gold mining company is a leveraged play on gold because you have the operational leverage, and so they are tied to gold. Gold is the asset class that they're tied to, and so the valuation for the company is, obviously going to be tied to it. And same with like CleanSpark with Bitcoin, for example. It's similar. So taking advantage of clarifying that statement, but kind of going back to your question, I don't find the need for it. If you find the need for it, Hamad, but that would be like a personal decision. So you have to understand the risks. With gold mining, you really do need to pay attention. Like the thing that gets in the way of gold miners is a lot of times the management teams. In reality, let's face it, the management teams are not really good at capital allocators. Most of them are terrible capital allocators, which is a big problem because management should be your capital allocator representative, right? So as a value metric, do you have any thoughts on Peter Lynch's fair value, i.e. earnings growth rate times earnings? I mean, it's one out of many variations. So like, for example, if you take a look at the PEG ratio, it's one measure out of many that an investor can utilize to determine if a company is trading exorbitantly expensive or not, right? So it's good to use. Like you can use it, and then you have to kind of be intimately knowledgeable or understanding as to what it is that it is measuring, but don't rely on it, wholeheartedly. But I think you know that. Carl's question: are you befriended with strongman? Yeah, I'd say we're befriended. If you look at healthcare REITs, what portion of the business are you most interested in? Senior housing, hospitals. So I have only exposure right now to hospitals. Senior housing is, I don't know why your question went away accidentally. Senior housing is also interesting. There's, for example, some operators like OHI, but the senior housing, I think there was almost like an exuberant investment into that where a lot of companies started propping up out of nowhere, which, for good or for worse, there were a lot of people in the 2010s saying that this would be like the new gold rush. You probably can find tons of videos of people saying that, pitching senior housing as the next big thing because of demographics. And while there is credence and truth to it, whether or not it's like always a good opportunity is a different question altogether. I think I'd have to do further research into the specific individual companies and kind of determine that, but I only have exposure right now to hospitals. Research facilities, you have, what was that one called? The really big one. What is that one called? They just did a big acquisition too. They're one of the larger ones, but they basically, as far as the property type, though, I can't remember the REIT for the life of me right now. My brain's actually dying. So research facilities as a whole is not as bad as, let's say, hospitals, but because that can be probably more easily retrofitted. But your tenants are probably not, they're still not that likely to leave. So it's still a good property type, in my opinion. That wasn't the one I was thinking about, Dan. I know I just saw that you just commented Alexander Real Estate Equities. that wasn't the one I was thinking about. It was a big one, one of the really big ones. I can't. Okay, I can put the unupdated link in the description. Yeah, let me actually do that then. Okay, let's see here. No limit and never. Okay, hidden use comment button. All right. And let me actually post it in the description, and then it should work for you. So I'm going to post it in the description of this exact video. So, but yeah, I don't know why. It should have not had an expiration. All right, so try now. I just saved it. So you should, if you reload this live stream, you should be able to see it. Okay, and then it should work. But hopefully that works for you. And then we can see you on there. Okay, so the thing about Australia, New Zealand, and the United States is that they don't have a well-defined national identity and make it. Yeah, so you're getting into like the meat and potatoes of things. You're going far deeper, and assimilating immigrants. Yeah, it could be differences. Which of the European struggles to accept immigrants from like China, Japan, and others? Yeah, you're getting to some meat and potatoes. No worries, man. Genentech? No, it's not that one. It's not that one. I'm trying to remember it. I can't remember for the life of me. If I actually, let me actually see if I can use this tool to try to find it. Elliott Investment Management, they extract value from Suncor right now. Well, I mean, in activist management, they're going to find any kind of company and try to see what they can do. But Elliott's pretty, I think they were trying to get involved in Intel, or am I thinking of the wrong one? I think they were the ones who were trying to get involved in Intel and trying to fix that up. I don't know if they still have their position in it, if it was them. Hold on, let me actually, I'm trying to find this REIT because it's bothering me. Let me see. If I pull this up. It's one of the biggest ones. How can I forget their name? It's terrible. Ventas. That's the one. Sorry. Found it. Ventas and Welltower. So those are the ones. I don't know why I forgot their names. So Ventas and Welltower. Those are two ones. Okay, do you think there is an actual index ETF bubble? I've read some of the literature on it. So like Mike Green is a big proponent. So I would actually say, you know, I don't have the answer necessarily, like whether there is or isn't definitively, but you ask for my opinion. So my opinion is that there could be one. I would never say that there isn't one. I'd say that if there is one, it's not that big of a deal anyways, because that would just mean that active investing, for example, from the standpoint of picking great companies is going to be better. You're going to have more volatility at times. Like, you know, you're going to have sharper drops, more rapid rises in that sense, because more money is quote unquote dumb money. So I would refer to the guy who's been, you know, talking more about it than anyone else I've seen, but there could be someone else talking about it even more. And that's Mike Green. So Mike Green's been talking about it for a long time. And so if you're intellectually curious, go check him out. Check out his work. Check out his interviews. He can provide more color. I don't know if you've already seen him and that's where you got it from, or if you got it from Michael Burry. But yeah. Okay, so this is where I'm going to... Stockmo is coming for me. I've never even talked about Stockmo. I haven't even still to yet watch any of his videos. I'm told they're very boring. I don't know. Okay, so that would be interesting. Yeah, that would be interesting. I'd be probably down for that. All right, guys. Thank you guys so much for watching. Again, this kind of replaces Monday's video. I wasn't able to film any videos today. But got you guys an hour-long live stream at the very least. Jap Gill, I plead the fifth. Absolutely, yes. And remember, plead the fifth for a wallet question. That was really funny. Where's your wallet? But he didn't say anything there. Has already pleaded the fifth at that point. Anyways, sorry, enough of the drama. All right, I'll see you guys on the next one, guys. I hope you guys have a great one. I'll probably see you guys, tomorrow in a video or something. But other than that, yeah, see ya.